My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Do you want to make friends? I'm just trying to save you some money. My job is not just to teach, but also entertain, put it into context. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When the market's going down, but nobody knows why, don't think about what you need to sell. Maybe change your perception and think about what you need to buy. Now, I know this is one tough market. Dow tumbling another 491 points, S&P plummeting 2.0%. Hey, NASDAQ plunging 2.98%. But that doesn't mean you should give up on looking for opportunities. But you got to do it carefully. How do you approach a day that's really hideous without much of a negative catalyst, other than the average were up and then they went down really fast, scaring everyone into thinking that something bad must be lurking? Well, first you have to ask yourself, is it even worth it to take a chance to buy something? I have to tell you, I think it is. Why? Okay, because you have to expect that there will be what I call mechanical selling on the third to last day of any quarter today. In the old days, you'd see people mark stocks up or down to juice the performance on the last day of the quarter. For most stocks, other than the real mega caps, money managers could come in with guns blazing and take the stocks up, enhancing their own performance. Same thing with the short positions on the downside. You know, it got so ludicrous, so evil, so just mockery that the SEC finally decided to crack down on the process. It no longer happens. Now, I know there's much more activity these days on the third to last day of the quarter. I mean, that's what I saw today. Lots of goofy stuff. Money managers dumping losing stocks or locking in gains, wanting to show their clients that they don't own some of the big losers in the first half, every little shenanigan. And that is where the opportunity comes in. Of course, before you take advantage of the mechanical selling, you need to have the most up-to-date information. So ask yourself, what's going on in the last 24 hours that would have moved the stock up if it weren't for the gravitational pull of the futures? It's too hard a market to go in with old information. Let's start with a bank stock. Let's start with Morgan Stanley. Why a bank stock? Because if you can find one without a lot of default risk, then you have a great pick in an environment where the Fed's raising interest rates. And the one with the least default risk in New York is Morgan Stanley. It's a bank chock full of collateral and any disturbing loss. Last night, after being scrubbed by the federal regulators, Morgan Stanley decided to increase its dividend by 11% and authorized a $20 billion multi-year buyback program. Now, this is only a $136 billion company. That's very substantial. And, by the way, it's real. They will stand there and they will buy stock. Why am I certain about Morgan Stanley? For the same reason I bought it for my charitable trust. It doesn't have the same business models the old Morgan Stanley had. It's chiefly about a durable earnings stream from its wealth management and investment management businesses. In other words, the new Morgan Stanley doesn't have the same risky profile as any of the other major banks. And after yesterday's increase, its dividend yield is nearly 4%, one of the largest in the land. Plus, it still benefits from the Fed's rate hikes like everybody else in the industry. I think that's a gem you can pick up for much less than you would otherwise. The stock was up a little today, but you know what? On any other day, I think this stock would have traded to the low single-digit 80s. It was that positive, a dividend boost and buyback. Next, really controversial, Disney. Now, here's a stock that's been nearly cut in half from its highs last year. At one point today, Disney was up big, but then it gave up the ghost once the sell programs kicked in. Why Disney? Because we learned today that China will soon allow them to open up Shanghai Disney, which is instantly additive to the earnings. The CEO, Bob Chapek, knows how to run theme parks, so there's a greater chance that the earnings estimates are too low and will need to be raised for once, not cut. And that is the number one driver of stock prices. Chapek just got a 3-year extension this very evening. Maybe that will silence the backbenchers, perhaps have them spend more time with their families. Oh, and while I'm at it, I think it's time for Disney to change the narrative. For the longest time, all anyone focused on here were the declining ESPN numbers. When they went down, which they did with much consistency, the stock got punished, regardless of what else was happening. Then Disney paid way too much for Fox. Chapek had nothing to do with that, in part to generate extra content for the Disney Plus streaming service. Now Disney Plus is treated like ESPN used to be. If it trades on these subscription numbers and Wall Street tends to find them wanting, the stock goes lower. Now, if I were running a show, which, by the way, just so you know, because of this commitment I have here, I'm not, I'd start talking about putting a new Disney theme park in the Texas-Colorado corridor. That is the fastest-growing region in America. Now, I know you might think I'm joking, but consider this. The most popular part of Disney, the most iconic division with the best pricing power, is the park business. And it needs a new flagship. Forget Disneyland in California or Disney World in Florida. Give me a Disney universe in New Mexico. Hey, it is the land of enchantment. All right, let me give you one more idea. Johnson & Johnson. The logic. This company's breaking up into a consumer products business and a separate pharma and medical device business. Each of these divisions is on fire. This is a stock that rarely, as we call it, comes in, rarely goes down. So I think a day like today, where it's down nearly 3%, is a nice buying opportunity. Look at these. Buy. They've all been buying opportunities. Now, you could say it's a bad idea to buy a drug stock in an inflationary environment, but this is not just any old drug stock. J&J is the best-of-breed drug company. It's splitting into two great businesses and a move that will definitely unlock a ton of value in the year 2023. So you got to take advantage of it now. You don't run from it. Full disclosure, we own Morgan Stanley, Disney, and J&J for the Charitable Trust and talk about these names all the time in our morning meeting. We did so today at 10:20 on CNBC.com. But there's one more I mentioned today that I think will make a ton of sense in light of the fact that China's beginning to reopen. And this is a shocker, one that I barely talk about, that I am going out on a limb right now on. Starbucks. Right now, Howard Schultz, the temporary CEO, is going around the world to check in with as many associates as he can. He needs it. He's kind of doing a listening tour in response to the surprisingly successful unionization drive. I think he's addressing many of the day-to-day concerns that have kept Starbucks from performing at its highest level, including, by the way, the day part where they really, really need to figure out how to handle cold drinks. But more importantly, Starbucks has a huge Chinese business, and when China fully reopens, that business is going to grow like crazy. Sometime I think it'll be bigger than the U.S. presence. Sure, there are still labor issues. I don't think they're going to impact the company's earnings. They're more headline risk, okay? So let me give you the long story short. When you hear China's reopening, I want you to think, buy, Starbucks. Now, these may not necessarily pan out, especially in the short term, but that's why you don't buy stocks all at once. You leg into them gradually, step by step, inch by inch. Buy some now, buy some later if they keep going down. And that is how you build a position. That's how professionals do it. With each of these names, you have good news in your pocket. You have fresh information. It's unlikely you're going to get any negative earnings pre-announcements for any of these companies. That's what makes these stocks buyable after an ugly day like today. The bottom line, while this may be a bear market, as I told you, as long as commodity prices come down, these stocks could be winners, which is why you've got to treat ugly moments like this one as buying opportunities. Not for everything, not even close, but for a select few stocks that truly has something good going on. I like that. How about we go to Lozara in Florida? Lozara.
Hi, Jim.
Lozara, what's up?
Hi. So my boyfriend and I are new to stocks and truly appreciate you and what you do to help people like us understand and make informed decisions in building our portfolios.
Oh, thank you.
You've become Uncle Jim in our household.
Holy cow, Uncle Jim. I feel like I'm in the Haleys. Fantastic. What's going on?
So my question to you is kind of a two-part question, but it's with regards to the stock that I'm calling about. It started dropping a few weeks ago before the major drops of all stocks, and it's due to the recent lawsuit lost. But the price now seems so great to keep buying into it at $130 a share. What are your thoughts on 3M? And if it's a buy, should I sell my Best Buy shares to purchase more 3M?
No, I don't want you to sell your Best Buy. I like Best Buy very much, and she's doing, Corey Barry's great. The problem with 3M is the lawsuits involve a particular kind of ear injury that I happen to suffer from. And I can tell you that it's the type of thing that these are soldiers, not me, I'm fortunate enough that it didn't come on the battlefield for me, that are very sympathetic in the courtroom. And so unless 3M starts winning all of the cases, you can't own the stock. Just can't. All right, you have to treat ugly moments like this one as buying opportunities. Not for everything, not even for many, but for select few stocks that have something going on that you have in your pocket. Mad Money tonight. Amazon Web Services is a powerhouse behind some of the world's biggest websites. I'm talking to the head of one of Amazon's largest divisions to see what the future of the cloud could hold. Then, Nike posted a mixed quarter last night. It translated some choppy action today, meaning it went lower. So what should you make of the stock in this tape? I'll give you my take. And you want my take? I'm going to give you my take on JetBlue and Spirit. And, yeah, I got to tell you, if you're a Spirit shareholder, you better listen up. I'm going straight to the source. the CEO spirit. I may suggest that you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.